Dividends are one of the most popular reasons people get into investing. In fact, there are many YouTube channels dedicated to dividend investing. Everyone loves the idea of earning a regular payout just for holding shares. But the truth is, dividends are often oversimplified. There's a lot more to them than just the cash you receive and the notification you see on your screen. Things like ex-dividend dates, yields, payout ratios, and the meaning of a dividend trap are all worth knowing about. And these are just some of the things you need to look out for. In this video, I'll break everything down in simple terms, from what dividends are and how they work, through to how to compare dividend-paying stocks and avoid common mistakes. But a quick word of caution before we begin: dividends are not free money. When a company pays out a dividend, its share price usually drops by the same amount. So while they can feel rewarding, what you're really getting is part of your investment returned to you as cash. This is not a video going into the details into the pros and cons of dividend investing. I'll save that for another video. But I had to mention this quickly to avoid the sensationalism that dividend investing is often surrounded by. It's important to think in terms of total return, which include both share price growth or loss and any dividends received. That is what is going to matter for your long-term returns. We'll see how share prices react to dividends when we talk about ex-dividend dates, but just keep in mind as we go that this is an educational guide and not a promotion of dividend investing over any other type of investing. This video is kindly sponsored by Stockopedia, the UK-based stock analysis and research platform helping you make more informed investment decisions. Remember, this video is not investment advice, it is for informational and educational purposes only. When investing, your capital is at risk and you may get back less than invested. Consider consulting with a financial advisor before making any investment decisions. So, what actually is a dividend? At its simplest, a dividend is a portion of a company's profit that is paid out to shareholders. Not all companies choose to do this though. Some prefer to keep profits as cash on the balance sheet, pay off debt, or choose to reinvest profits to try and grow the business. For companies that do pay dividends, the payout frequency can vary. Some stocks pay monthly, others quarterly, twice a year, or even just annually. But it's important to understand that dividends are never guaranteed. Just because a company paid a dividend last year doesn't mean it'll do so again. Companies can cut, reduce, or cancel dividends entirely at any time. This often happens during economic downturns or if the business hits a rough patch. For example, in 2020, we saw many companies cut or cancel their dividends due to the fears surrounding the COVID pandemic. Some businesses may take a long time to start paying dividends at all, if ever, because they believe that reinvesting profits will deliver better returns to shareholders over time. In other words, they believe they can use the cash better than you. For example, if we look at Alphabet, the parent company of Google, on Stockopedia, we can see that it's only started paying a dividend recently. It is a relatively small dividend, but I guess it gets to a point where these Magnificent Seven companies just have so much cash they don't know what to do with it. So they pay some out, whilst also spending significant amounts on reinvesting back into the business. We'll talk more about dividend cover later in the video, but for now it's worth noting that this figure tells us Alphabet are paying out a very small percentage of their profits as dividends. Alphabet may not have paid out much in the way of dividends over the years, but it has certainly been a good investment. My point here is that dividends are just one way companies return value to shareholders. In this video, we're focusing on understanding them properly, but remember there's no single right approach when it comes to investing. What matters most is making informed investment decisions that are right for you. Now that we know what a dividend is, the next thing to address is dividend yield. But before we can understand the yield, we need to know about something called the dividend per share, or DPS. This is simply the amount of dividends a company pays out per share over a given year. Once you know the dividend per share, you can calculate the dividend yield by dividing that figure by the current share price. For example, if a company is expected to pay a DPS of £1 and the share price is £20, then the yield is 5%. Sounds pretty simple, right? But this is where many beginners start to obsess because dividend yield looks like an easy number to chase. After all, who wouldn't want a 7% yield instead of a 3% yield? The key thing to understand is that yield can be based on either trailing or forecast figures. A trailing yield looks backwards. It's based on what the company has paid out over the last 12 months. A forecast yield is based on the forecast dividend per share, what they'll pay out over the next 12 months. These can be very different. If a company has just announced a dividend cut, the trailing yield might still look high, even though the actual payout is set to drop. Also remember, dividend yield is not fixed. It changes constantly because part of the calculation is the current share price. If the share price drops sharply, the yield automatically increases. But this does not suddenly mean it's become a great dividend stock. This is why it's important to be cautious with unusually high yields. Sometimes they reflect genuine value, but other times they can be a sign the market expects a dividend cut. This is also why it's important when you're looking at dividend growth to focus on the actual dividend per share, not the yield. That's because a rising yield might just mean the share price has fallen, not that the dividend has grown. So how do you actually qualify to receive a dividend payment? You need to understand the key dates involved, especially something called the ex-dividend date. Every dividend payment has a few important dates attached. The declaration date, when the company announces the dividend, the ex-dividend date, which is the key cutoff point, and then the payment date, when the money actually lands in your account. To qualify for the dividend, you need to own the shares before the ex-dividend date. If you buy the shares on or after the ex-dividend date, you won't receive the next dividend payment. For example, I'm looking at JGGI on Stockopedia here, and on the dividends tab, I can see that there is an upcoming dividend that went ex-dividend on the 22nd of May, and it will be paid out on the 23rd of June. So I know I will receive that dividend as I owned my shares before the ex-dividend date. Now remember earlier when I said dividends aren't free money, the ex-dividend date is where that shows up most clearly. On the ex-dividend date, all other things being equal, the share price typically drops by the same amount as the dividend per share being paid. So if a company is paying a 50p dividend, its share price may fall by around 50p at market open on the ex-dividend date. Legal & General is a great example here, as it pays out a pretty chunky final dividend. On the ex-dividend date, which was the 24th of April, we can see a significant share price drop. That's because the value of the company has just gone down by roughly the amount it's paying out, and the market prices that in instantly. The cash is no longer on the balance sheet and instead is on its way to shareholders. So while it can feel like you're being paid to hold the stock, all that's really happening is value being transferred from the share price to your cash balance. The next thing that people often look at when analysing a dividend-paying stock is its track record. Has the company consistently paid dividends over many years? Has it grown those dividends, or has the payout been flat, or worse, cut? A consistent dividend history can be a sign of a mature, stable business with strong cash flow and a commitment to returning profits to shareholders. It's especially attractive for long-term investors who want some degree of reliability from their income. Of course, we also have to keep in mind that a good track record is not a guarantee of future dividend increases, but it can be a good sign. Using the dividend history chart of Legal & General on Stockopedia, for example, shows a strong track record of dividend growth for LGen. In 1988, the final dividend was 0.706p per share, and in 2025, it was 15.36p per share. We can also see that after the global financial crisis around 2008, the dividend was cut. Before we dive any deeper, I wanted to say a big thank you to Stockopedia for sponsoring today's video. When I'm researching individual stocks, Stockopedia is one of the tools I rely on most. Their stock reports pull together everything you need in one place, from key financial metrics to valuation ratios, growth trends, broker forecasts, and director dealings. There's a dedicated dividends tab too, which makes it easy to track upcoming payouts and analyze a company's dividend track record at a glance. But what really sets Stockopedia apart, and the reason so many private investors swear by it, is the proprietary stock rank system. Each stock is scored out of 100 for quality, value, and momentum, the three key drivers of long-term investment returns, according to decades of academic research. These factor scores are then combined into an overall stock rank, giving you a quick, data-driven way to compare companies and uncover potential winners. And this isn't just theory. Stockopedia has run extensive backtests, and over the past decade, high stock rank shares have significantly outperformed low ranking ones. It's not a crystal ball, you still need to do your research, but it's a serious edge you can use to stack the odds in your favour. If you want to give it a go, you can get a 14-day free trial and 25% off your first subscription with the code TP25, or just hit the link in the description. Now, let's talk about how sustainable a dividend actually is, because not all dividends are created equal. One of the key metrics here is the dividend payout ratio. This tells you what percentage of a company's earnings are being paid out to shareholders as dividends. If a company earns £1 per share and pays out 70p, the payout ratio is 70%. Closely related to that is something called dividend cover. Websites usually use one term or the other, so it's worth knowing both. Dividend cover flips the ratio around and shows how many times a company's earnings can cover its dividend. It's calculated by dividing earnings per share by dividend per share. A dividend cover of 2 means the company earns twice as much as it pays out. This could also be referred to as a 50% payout ratio. A dividend cover of 1 means it pays out everything it earns, which can be a red flag. this would be a 100% payout ratio. But of course, context matters, so you need to take into account a company's financial position, its balance sheet, forecasts, to understand if a dividend is sustainable. Going back to Alphabet as an example, we can see that the dividend cover is estimated at 11.9 for 2025. This means the dividend is covered almost 12 times by earnings. In other words, the dividend is very safe, and at expected earnings, they can definitely increase their dividend significantly if they wanted to. This sort of cover is quite rare though, and for popular dividend-paying stocks, you will often see a dividend cover between 1 and 2. Now, unfortunately, as with any investing guide, we also do have to briefly cover tax, because while receiving income is great, it's important to know what taxes are applicable. In the UK, you get a tax-free dividend allowance each year. In the current 2025-26 tax year, that allowance is £500. Any dividends you receive above that amount are taxed at your marginal dividend tax rate, 8.75% for basic rate taxpayers, 33.75% for higher rate, and 39.35% for additional rate. This applies across all your dividend income, including from UK and overseas stocks, unless you're using a tax-efficient wrapper. That's where ISAs and SIPs come in. If your shares are held within a stocks and shares ISA or a pension like a SIP, then any dividends you receive are completely tax-free. However, ISAs only shield you from UK taxes. If you're investing in foreign stocks, you need to be aware of withholding tax. For US stocks held in an ISA, you'll usually pay 15% withholding tax on dividends after submitting a W-8 BEN form. For US stocks in a SIP, many platforms allow you to claim back the full withholding tax, so you may pay zero, but this depends on the provider, so always check with them or speak to a financial advisor. When it comes to actually constructing a dividend portfolio, a key thing to understand is that dividend yields can vary greatly between sectors. Some industries are naturally more income-focused. For example, utilities, telecoms, and consumer staples tend to offer higher yields because their businesses are mature, stable, and generate reliable cash flow. On the other hand, sectors like technology or communication services often reinvest profits into growth, so they typically have much lower yields. This is important when building a portfolio because if you're focusing on getting a very high yield, you may end up building a very concentrated portfolio without realizing, heavily focused on some sectors whilst missing out others completely. This can increase risk and may harm your potential for long-term returns. On Stockopedia, you could potentially build a screen to find high-quality dividend-paying stocks in each sector and build a diversified portfolio this way. For example, some filters you may want to include a yield filter, DPS CAGR filter, and a quality filter to remove the junk. Speaking of quality brings us on to the final section of this guide. There is often a trade-off between high yield and high quality. As mentioned a few times, a high yield could be a warning sign of a low-quality business that is in trouble. It's important to look under the bonnet and see what is going on. Yes, the yield is high, but are earnings declining? What are the debt levels like? The operating margin? The list goes on. Without analysing these things, you could fall into a dividend trap. Stocks that look attractive on paper, but are at risk of cutting the dividend or underperforming over time. For this reason, I believe the best way to pick a dividend stock is to strike a balance, favouring companies with strong balance sheets, consistent earnings, and a sensible dividend policy, rather than chasing the biggest yield available. One such example of a high-quality dividend stock that has performed well is Games Workshop. Now, to be clear, this is not a recommendation. I have no idea how it will perform in the future, but it is a good example here as it pays out a decent dividend. They have a clear dividend policy of paying out surplus cash to shareholders, the earnings have consistently increased, and the operating margin and balance sheet are super healthy. Again, to be clear, this is not a recommendation as you also have to take into account valuation, which is currently very high for Games Workshop. Stock picking is never easy. My point is, it doesn't always have to be a trade-off. There are companies that offer both decent yields and solid fundamentals. You have to be selective. Hopefully this video has helped you get to grips with the basics of dividend investing. Not just what dividends are, but the key terms you need to know and what to watch out for. If you're thinking about building a dividend portfolio, or you want to see how to apply some of the ideas we've covered today, you might want to check out my other video on how to find the best UK dividend stocks. It goes deeper into the mistakes to avoid, factor investing, and walks through a Stockopedia screen you can use to start building your own shortlist. Thanks for watching, and I'll see you in the next one.